Hey everyone, thank you so much for being here. Before we kick off this week's episode, just a quick ask. Please don't forget to like, subscribe, hit the notification bell to make sure that you never miss an episode, never miss out on any of the strategies and tactics that we're sharing to help you continue charting your own path to freedom. And if you'd like to go deeper with any of this, we've launched a free Facebook group, which you can join at pathtofreedom.com/group. And we've linked that in the show notes to make it easy for you to find. All right. Thank you again for being here. Let's drop in to the episode. Hey, what's up, everyone? And welcome back to the Path to Freedom podcast. Today, I'm joined by Jacob Vanderslice, and Jacob is the co-founder of Van West Partners, where they raise capital and invest in self-storage assets. Something I've been very, very curious about for a long time. I mean, I can remember, going back to when I was a kid, hearing an uncle of mine talking about investing in storage units. And, it just seems to be one of those things you constantly hear. It's a very good, asset class of real estate. But I think like a lot of other asset classes of real estate, for kind of the real estate investor novice, there's just a lot to learn and a lot of uncertainty around, how can I get started, to go out and buy a self-storage lot on your own requires a lot of capital. Probably a lot of people are not in a position to do that. So from what I understand, you guys are kind of creating opportunities for people to invest smaller chunks of capital into these funds that you're putting together to go out and acquire these self-storage properties. Is that a pretty good way of describing it, Jacob?
Yeah, you got it. And good to see you again. Thanks for having us on today. We appreciate it.
Yeah, man, I've been excited about it.
Yeah. We generally target, we'll do some development occasionally. Development's kind of a different risk profile, but most of the deal types that we target are inefficiently operated storage facilities from a revenue management perspective. Maybe they don't have a website. Their rents are below market. Their expenses are above market. Maybe they've owned it for a while and they have a low basis. And we'll target these acquisition types and we'll add value first with capital improvements, but mainly through our operational platform. We self-manage our portfolio, and management is really where I think a lot of the value creation comes into real estate, whether it's multifamily, storage, retail, whatever it might be. People say you got to buy it right, but I think as important, if not more important, is you got to operate it the right way. So our different vehicles, we have a series of self-storage funds and a number of different single asset syndications, and we'll raise capital from investors and we'll put it to work and value add storage facilities.
Yeah, it's interesting because I've guess just had a chance to learn a little bit more about multifamily real estate investing and some of the funds or syndications that are out there. And that seems to be the key there too, right? Is just improving management and, optimizing, controlling expenses better, maybe bringing something up to, current day standards so that they can increase rent. So it sounds like a lot of that's applicable within the storage unit asset class as well.
Yeah. There's a lot of similarities between storage and other real estate asset classes. And, whether you're developing or you're buying a value add deal, whether it's multifamily, storage, industrial, generally your singular focus, to kind of oversimplify, is growing net operating income, or NOI. Mm-hmm. And those of us listening might have heard of that term before, but high level and simply, NOI is purely gross revenue minus expenses. And a lot of real estate deal types will trade on a multiple of that net operating income or a capitalization rate. Okay. So again, whether you're building or buying existing, as an operator or investor, you're endeavoring to grow net operating income. And that's where the value creation happens.
And is your model to, buy a self-storage complex, make these improvements, grow that net operating income, do that over a certain period of time, and then sell it for that multiple? Is that the end game, or are you, buying these and holding them long term for the cash flow?
Yeah, I'll talk out both sides of my mouth here, which I often do. The first thing I'll say is Philosophically, we're longer term holders. We
Okay.
like durable recurring revenue streams. We've endeavored to build an asset base that's responsibly financed that just creates cash flow.
Yeah.
And generally, we don't like selling quickly. Now, with that being said, the other side of my mouth, we sold 6 deals in the last year, and we had modeled those hold periods for about 7 years. And we sold them after 2 to 3 years, and it just made sense to. We get some offers we couldn't really refuse. It was a good
Yeah.
return, and you kind of balance that against the future cash flows, money today versus future cash flows later.
Yeah.
But overall, we underwrite our deals for a 5 to 7 year hold period, kind of depending on the deal type. On our single asset syndications, those are typically more on the 5 year side, and our fund vehicles are more on the 7 year side. But those hold periods are not set in stone, and nowhere in our offering documents does it say that we have to sell a deal by a certain time. And the reason for that is, let's say the market materially declines on year 5. Let's say we were required to sell on year 5. We don't want to be forced to sell into an environment that's not good to sell into.
Sure. Yeah.
But we endeavor to return investor capital as quickly as we can without sales via operational cash flow, refinances. But yeah, 5 to 7 years is kind of the time range that we target, and some deals could be a lot longer, and some we could blow out of after 2 years. Just kind of depends on what the market's bearing.
It's the old adage: everything's for sale at the right price, huh?
Yeah. We had one of our investors, very very intelligent and successful, and he's probably 80. And on kind of our first call together, he asked me, when are you boys going to sell these? And, I was like, well, sir, we underwrite this, we underwrite that. And he asked me, he's like, the problem with selling, right? And I was like, no. And his response was, you don't own it anymore. And that was one of the deeper observations I've ever heard in a very simple way on real estate finance. Like, gosh, yeah, if you sell it, you don't own it. Yeah,
Yeah, that is a good point. Yeah, well put for sure.
Yeah.
So, how did you get into the self-storage category? It seems like you've been in real estate for quite a while. Have you kind of invested across a lot of different types of real estate, or has self-storage always been the primary focus?
Well, everything we've learned over the years, we've learned by failing. The successes you kind of forget about, and the home runs, but the failures you remember like they were yesterday.
Yeah.
But I do them again. I'd repeat it all again just because of what you learn making mistakes. But for many years, we've been investing in real estate full time since '06. And we primarily did residential fix and flips. We did a lot of them, hundreds and hundreds of them, all over the country, mainly in Denver. We did some adaptive reuse retail. We did some townhome developments, some multifamily. We covered a lot of the real estate bases over the years. And we did our first storage deal in 2015. And we had looked at the asset class for a while. And one of the things we didn't like about our business, which has become more clear in the rearview mirror, but it wasn't as clear at the time, is our business was kind of overly transactional. We were buying and selling too often and too quickly. It's inefficient on taxes. If you look at wealthy, successful people, regardless of how they got there, often their path was the accumulation and holding of assets, just asset accumulation incrementally over time, and having that discipline to kind of hang on and not sell. Yeah. And obviously, if you're buying, fixing, and selling, every 4 to 6 months, that's just transactional.
Yeah.
And we thought storage was a good vehicle to kind of shift our thesis over. And when we did our first deal at the time, it wasn't really an intentional strategic pivot. We're going from a residential operator to a storage operator. It was more, let's try one out and see what happens. And did a second one and a third. And slowly over time, we evolved to being almost exclusively a self-storage owner operator. So it's been a good asset class to us. It's been something that can scale, I think, a little more easily than infill, adaptive reuse retail, and single family buy, fix, and sell deals. So we'll see how it goes. But yeah, we're all in on storage.
Yeah. Well, what, nine years in, if you started in 2015, so must be going pretty well for you to have stuck with it for coming up on a decade now. I imagine too, like if you compare it to something like the fix and flips and doing, high volumes. I mean, if you were doing hundreds of them, obviously you weren't, physically doing any of the manual labor, I would assume, on these, homes that you're fixing up and then flipping. But I mean, look, we owned an insulation business. We sold it last year, and the lifestyle component was a big part of us selling it. It's just the type of business that, the only thing that's guaranteed is, you're going to have headaches no matter how well you prepare, no matter how many systems you put into place. So I imagine self-storage compared to fix and flips and probably, even owning a bunch of single family, homes and having long-term renters in them, self-storage is a much more lifestyle friendly, way to build a real estate portfolio.
Yeah, it's a different set of problems. There's always problems with everything,
Fair.
right?
Yeah, sure.
It's a knife fight every day. We've got 90 amazing folks on our team. We've got over 18,000 units. We've got 37 facilities around the country.
Wow.
And in theory, you hear often that self-storage, no tenants, no toilets, no problems. And that's true in the regard that the eviction process is a little bit simpler. You can remedy delinquencies easier, especially compared to states that are much more landlord friendly. But there are plenty of challenges. We've got people sleeping in units. We've got theft, break-ins. We've got U-Hauls backing into our $30,000 gate that we just installed.
Yeah, I could see that.
We got trucks backing into our buildings, and there's always something going on, right? So it is operationally intensive, but it's just kind of a different level of operational intensity than residential, for sure.
Hey everyone, we'll get right back to the episode, but I wanted to quickly share a free resource with you. If you're curious about franchise ownership and want to learn more about how countless people, including myself, have leveraged franchising as a way to create more freedom for themselves and to take control of their livelihood, I've put together an ebook. It's called Franchise Wealth Creation, and it's the perfect starting point for anyone that's just curious to learn more about this whole franchise thing and how I've helped hundreds of other people navigate all the steps involved in understanding and researching franchising. So click the link in the show notes, fill out a short form. I'll send you the ebook. I think it's a great starting point if you're curious at all about learning more about franchising. All right, let's get back to the episode. Yeah, that makes sense. And to your point, everything's going to have its own challenges and share of problems. And as you started talking, I started, realizing how many issues a storage unit, can have. We've had storage units in the past, and seen, been privy to some of what goes on. I wasn't planning to ask this, and you may not be comfortable answering it, but since you kind of, went there with some of the issues, I imagine most people listening have seen like Storage Wars and those types of shows. Like, what's the craziest thing that you've ever been aware of that's been found in one of your storage units? Do you have any funny stories along those lines?
Yeah. I've got more than we have time for, so I'll try to be succinct. But Storage Wars, I think a lot of that stuff is planted. Big surprise.
It seems like it is. Yeah.
But we've had this happens somewhat frequently, but we've been served with a number of DEA search warrants for criminals that are storing drugs in their unit or stolen goods, and that's not like a one-off thing. It happens somewhat regularly.
I believe it.
We had in our office building here in Denver, we had self-storage on the main floor for a while, and we decided to convert it to an industrial tenant because it was just too small to kind of mess with. But we're all hanging out in the parking lot one day after lunch. It's a nice sunny day, and a pizza delivery guy shows up, and he's like, "Hey, where's unit whatever?" And it turns out a dude sleeping in his unit had ordered pizza to his storage unit.
That's great.
That was pretty wild. And then around the same time, we had a guy with a stolen U-Haul, and he had changed out the license plate, and we told the cops, like, "Hey, you've been looking for this guy. He's here right now." So 4 or 5 cop cars come over. we're looking out our windows like a bunch of Garfields watching this thing go down.
Oh
And
yeah.
the cops had this guy at gunpoint, and he reached in his pocket, and we're like, this is about to go bad. And he took
Yeah.
out like a crack pipe or something and threw it over the fence as if he thought the cops weren't going to see him do that.
Right.
And thankfully, he was peacefully arrested. But yeah, stuff like that happens pretty constantly. I mean, you've
I
got,
believe it.
whether
It
it's apartments
reminds.
or storage, you got some bad people out there, and they're doing bad stuff.
Yeah. Well, and I mean, it's probably a better option, if you're trying to be sneaky or, hide something away. Like, there's so many storage units. Yeah. It reminds me of my days working for Enterprise Rent-A-Car. That was my first job out of college, and I went through their management trainee program. And yeah, I've got so many stories of, cops calling in, asking about a car, someone's running drugs with it. Police showing up to the branch asking about an individual that rented a car. Showed up to open my branch one morning, and there was a car parked outside the gate running with, I think the total ended up being 50 some bullet holes riddled up and down the side of the car, and like bloody rags all in the back seat, and
Wow. Wow.
yellow police tape around the branch for the rest of the day. So yeah, rental cars and storage units maybe have more in common than I would have thought.
Absolutely. It's all hard. It's all hard. None of it's easy. Yeah.
Yeah. Yeah. So, like one of the things we touched on earlier was like some of the similarities between multifamily, real estate investing and self-storage, especially the way you guys are doing it through these funds. What are some of the characteristics, and you may have touched on some of this already, but what are some of the characteristics that in your mind, at least for you personally, have made self-storage more attractive than multifamily?
Yeah, well, I want to be clear. I love workforce housing. This country continues to shift somewhat quickly, I think, to a nation of renters versus a nation of
Yeah.
homeowners. Right?
Oh
You've
yeah.
got affordability, you've got the wealth gap, you've got rising interest rates. It's harder to buy a house than it's ever been before.
Yep.
So more people are renting. But one of the reasons we like storage versus other real estate asset classes is the revenue management is very dynamic. A lot of people don't realize this, but customarily self storage leases are all month to month. So
Yeah.
your customer likes that because they don't have a long term lease commitment. Their perception is they can kind of come and go as they please. But what ends up happening is most of our customers keep their unit for longer than they anticipate. For those
Totally.
of us listening right now, if you've had a storage unit, I would say it's fairly likely that you thought you were going to be there for 4 months and you were there for a year. That's just kind of what
Yeah.
happens.
Yeah.
One of our portfolios, we haven't owned the deals this long because it's a more recent portfolio, but our average customer in there had stayed. More than half of our customers had been in their unit for over 3 years. So
Yeah.
even though the leases
Yeah.
are month to month, it's a pretty sticky customer base.
Yep.
So the customer likes that flexibility, but on the ownership side, the month-to-month lease is attractive because we can respond real time to supply and demand changes. So if we have a unit type that's full, we can raise rents incrementally and probably not get any move-outs. And likewise, if we have a unit type that's maybe struggling on occupancy, we can drop rents below market and kind of start raising them as we reach physical occupancy stabilization. So we've got a revenue management team, and all they do multiple times a day is look at our rates compared to our competitors and basically respond not quite real time, but almost real time on what the market's doing. So that's one of the attractive aspects of it. We also like the granularity of the revenue stream. So we're not relying on one large user to pay us rent. And we've got some retail buildings with tenants that are paying us, $40,000 a month in base rent and CAM. And if they roll over on you, it's going to take a long time and a lot of money to find a replacement tenant. Whereas the chances of you losing $40,000 a month in rent from your storage portfolio all at once is very low. So we like these kind of bite-sized incremental revenue streams that in scale, they add up to be meaningful. But on the individual unit basis, your lights aren't going to go out if an $80 tenant or customer stops paying you on their unit, right?
Yeah.
We also like the fact that it's been, we'll see how this plays out and what the world does. But historically, the asset class has been fairly downside protected. It's performed well during periods of economic softening, periods of economic expansion. It's just kind of an overall resilient in general. There's certainly risks to it, but those are a few of the reasons that we like it. But
Yeah.
again, don't get me wrong, workforce housing, if you've got attainably priced for rent housing, I think your demand curve is going to be indefinitely fairly strong, just given kind of the state of the real estate market.
Yeah. Well, I agree with that, but some of the things that you just listed that for you are so attractive about self-storage make a ton of sense for me. And I hadn't thought as much about the benefits of it being, month to month. And, because to me, it's like, my kind of area of focus is franchise ownership, right? So it's very similar to some of the fitness concepts that I work with where, they're month to month, but, owners and business investors love the recurring revenue model, the predictable monthly revenues. With a lot of these fitness concepts, people end up keeping the memberships longer than they anticipated, even if they're not doing it. It's almost kind of like your Netflix subscription, right? Like once you've had it long enough, you're not going to balk if Netflix raises their price by $1 a month. You're probably
Yeah.
not canceling, but
You may
at
not even notice.
scale,
Yeah.
you don't even notice it. But at
Yeah.
scale, like that's huge, right? I mean, I don't know how many subscribers Netflix has, but just use simple numbers. If it's 100 million, they can raise their monthly revenues $100 million just by increasing the price $1, and they probably lose next to nobody. So yeah, that's interesting. It makes a ton of sense. And I think you mentioned this earlier too. The eviction process is easier, when you do have to get someone out. Probably not the time or place for it, but I went down a rabbit hole the other day on Instagram following these guys that I think they're mostly in California, where they've got a big problem with squatters, and how difficult it is to get a squatter out of your property if they've been there for a certain amount of time. That's scary, so that's probably not as big of a deal in multifamily, I suppose. But anyways, there seems to be less of that with the self-storage category.
Yeah. Well, either way, the rights of property owners are diminishing by the year for sure.
Yeah.
And that's
Yeah.
turbocharged depending on, what markets you're in, but it's kind of a scary environment. And we're not overly concerned about this, but there could be legislation that governs, the rate of rent increases on storage facilities or
Really?
the eviction process if someone gets delinquent on you. So far that's not getting a lot of traction, but there's certainly government risk out there in the industry at some point.
Yeah. Well, we could probably do 10 podcasts on.
Oh yeah, don't get us started. Let's sit down in the bud right now. Yeah.
How we've gotten to this place and the direction, some of these things seem to be headed with property owners getting less and less rights, but we'll stay off of that for now. So what about demand for storage units? Because you mentioned you guys, do a little bit of development. So I assume by that you mean you're actually going out, you're buying land, you're standing up a new self-storage facility. I understand that's not your core business or your primary focus, but like in my area, I live in coastal North Carolina. This area has been growing like crazy, for the last 10 plus years, but really, since 2020. The population's just exploded in this area, and it's just like car washes. Storage units are popping up everywhere. And are there some areas of the country where you worry that there's an oversaturation of self-storage, or is it, as Americans, we all hoard so much shit that we don't need that you almost can't have enough storage units?
Yeah, we talked about the reasons we like it earlier, and now we can touch on the risks. So the main risk in self-storage, beyond your standard real estate risks like cap rates, interest rates, rents, property taxes, your main risk is new supply. And self-storage supply is so slick. It's so kind of a sub-market cyclical. It really peaks and troughs fairly quickly. A couple examples. Denver around 2018 saw what we refer to as a supply shock, meaning the market was fairly steady, supply ratios were pretty consistent, and all of a sudden a bunch of people have the same idea at the same time. They deliver within a year of each other, and because storage demand is very submarket sensitive. Like in the 1, 3, and 5 mile trade radius, if you have a bunch of new product hit the market, rents and occupancies are going to go down, obviously, as operators
Yeah.
try to get somebody in their units.
Yeah. Yeah.
And then Denver, to use that as another example, it became oversupplied. And then in the subsequent years, everyone pulled out, right? Oh, we can't build anymore. There's too much product. We get crushed on the steel. We're not building here anymore. Well, that supply contracted. All those new buildings got filled up. And in the last couple of years, it's made sense to build again, notwithstanding, inflated hard costs and interest rates, but the macro fundamentals made sense to build. So we have one deal that we delivered about 5 months ago north of Denver. We have a deal that's under construction right now in Southeast Denver that'll open in March, which probably means it'll open in May. You know how construction goes.
Yeah, for sure.
So it makes sense to build on a kind of limited basis. Development's much higher risk, but for value add acquisitions, one of the first things we're looking at in the submarket are, first of all, the supply ratios, right? How many square feet per capita of storage is there? But we're more so looking at what the historic supply ratios have been.
Okay.
So you might buy in a market that's got really high supply ratios, but it's been that way for years, and most of the facilities are at 90% occupancy. And generally, these higher supply ratio markets can support higher occupancy because rents are lower and more of the population can afford to store. Versus, say, in Seattle, rents are really high and it's much more sensitive to an increase in supply. So that's really your main risk. And another market example, Phoenix right now. Phoenix is seeing one of the highest year-over-year street rate declines, meaning the asking rate. There's a lot of kind of other data points behind that, but to keep it high level, rents have gone way down, at least asking rents, and there's been a major supply shock. So Phoenix as an MSA is going to probably have some occupancy and some revenue problems. But with that being said, there are still submarkets in Phoenix that might make sense to buy or build, right? This little pocket over here in this 3 mile trade radius doesn't have anything coming. There's no other storage facilities. Let's build one or let's buy one. And even though Phoenix has got negative headlines, that little neighborhood in Phoenix might be a good place to go. So it's very submarket specific and it's very cyclical, just peaks and troughs, supply and demand. Everyone builds at the same time. They follow the crowd. Rents go down, building stops, and then you jump back in.
So key takeaway there is if you don't understand everything Jacob just went over, don't go buy a piece of land with the plan to throw some storage units up on it, because you may find yourself up the creek without a paddle. But no, it makes sense that so much of that would go into it. And I mean, how closely do you look at the type of storage units that are already in a market? Because you've already talked a little bit about the fact that some of the opportunity in purchasing a self-storage facility is if there's opportunity to improve it and improve operational efficiencies and things like that. I imagine that is a factor as well. If the self-storage that's there is of a low enough quality and there's opportunity to come in with newer, cleaner facilities that are better security, more protected, there's going to be a demand for that. Is that something you guys look at as well?
Yeah, I mean, to kind of distill it down high level, your food groups and your product types in self-storage, you've got climate controlled units and you've got non-climate controlled units.
Right.
And then kind of within that, you've got deal types that are multi-story elevator access. Maybe they're 5 stories. The one we're building in Denver is 5 stories. And then you've got deals that are your single story, traditional. There's 8 buildings. There's a bunch of drive aisles and roll up doors.
Yeah.
And the deal types we target, they of course vary by the market. But beyond the supply ratio component I touched on earlier, what we're really trying to understand when we underwrite a potential new acquisition is what are the submarket rents like on a 10 by 10, a 10 by 20, climate controlled, non-climate controlled. And before I go further on that, if you think about it, each unit is its own product type. So for example, in a multi-story elevator access building, you've got a bunch of 10 by 10s, but you're going to get a premium for the 10 by 10 that's on the ground floor, that's right next to the front door, versus the 10 by 10 on the 4th story, and you have to ride an elevator and push your cart 100 feet down the hallway. So
Totally.
every unit's got its own kind of pricing algorithm, and the value creation really is optimizing that pricing. And the deals that we target, the seller may know what they're doing and they built it, they have a low basis, but they may not be optimizing their revenue. They may not have ancillary income streams. We'll touch on that for a moment without going too far into it. But
Yeah, I'd love to.
storage industry, yeah. So some examples, and there's things like this in multifamily too, like utility billbacks and whatnot. But in storage, the main ancillary income streams are late fees. It's obvious what that is. One-time administrative fees when you move in, merchandise sales like boxes and tape,
Mhm.
U-Haul truck rentals. We have a lot of U-Hauls on our sites, and we revenue
Yep,
share
yep.
with U-Haul. They provide the truck, we provide the kind of the operations to get it leased out. But our biggest component of ancillary income streams is tenant insurance. So,
Ah,
believe it or not, most storage leases stipulate that the owner is not responsible for the contents of the unit. So if there's
yeah.
fire, theft, or flood, it's not our problem. So we require our customers to either present proof of coverage on their homeowner's policy or buy what we call a protection plan from us. And in round numbers, we pay our carrier about $2 a month per unit for our premium, and we charge our customers between $10 to $25 a month depending on the coverage amount. So that's a meaningful income stream. And again, if you net out, call it $15 a month on that, that's not a lot of money. But like the Netflix example, when
Let's
you
go.
amortize that
Yeah.
across thousands of units, you annualize that, you put cap rate on it, you've created a lot of value,
Yeah,
not
man.
only from an appreciation perspective, but a cash flow perspective.
Yeah.
So those ancillary income streams, for example, year to date, they comprise about 13% of our top line revenue.
I was
So
gonna ask what and is that ideal? Is that kind of what you would target?
yeah,
That
that's on the
that
higher end of the industry average, and it varies from deal to deal. Like your storage facilities in submarkets with higher income demographics, you've got more homeowners, and they've got more homeowners insurance, obviously, because they own houses. And so when you tell them, hey, you got to present proof of coverage, they'll pull out their insurance app and show it to our on-site manager, and they don't buy a protection plan from us. But in some markets with a lot more renters, our insurance penetration is quite a bit higher.
yeah.
And people often sign up for it too, because again, they think they're going to be there for 3 months, and sometimes they are, but typically they end up staying a lot longer. So those ancillary income streams are a pretty meaningful component of our overall value creation. So
Yeah.
we're
It's
working,
another.
getting those implemented, and then two of the ways we increase revenue are obviously filling up a vacant unit, occupancy growth,
Yeah.
and existing customer rent increases. So if you've been there for a year, you're below market, you might get a 10% increase on month 13, and you'll probably stay.
Yeah, exactly. So that's really interesting with all these ancillary revenue streams. It's another similarity between enterprise and storage units I'm seeing here is the protection plans that you can buy, and that
Well, yeah,
being
the margin on car
you know,
rental insurance, I mean,
yeah,
most of us
it's
listening probably
meaningful.
decline it because we've got it on our auto policy or our Chase Sapphire
Or
card.
Amex, yeah, yeah.
But a lot of people buy that, and
Mhm.
the guy renting you your car, an enterprise, is probably compensated to pitch you on that insurance because they
It's
make a
how
lot of
we
money.
were. It's how we were. It was the biggest metric that we were kind of graded off of, and I don't know that this is the best strategy because essentially the best salespeople are the ones that would get promoted, and the best salespeople don't always end up being the best managers. But that was how you worked your way up. Was could you sell the roadside assistance? Could you sell the protection packages? Could you get them into an SUV when they booked a full size car, those sorts of things. And it's meaningful, right? Especially at scale. I don't know how many millions of cars Enterprise has in their fleet at this point, but it's a lot of them, and they spend a lot of time training their employees to offer these things and explain the value of them. So
Yeah,
yeah, that's
briefly,
interesting.
one of the large REITs, if you go to one of their sites that's either owned or managed by them, and you walk around the desk to their on-site manager's computer screen, their main metric on that screen is not occupancy, it's not rent, it's insurance. how much insurance did you sling today or this month? What's that revenue look like? And it's a huge profit center. It's not a lot of dollars, but the margin is pretty
Right.
enormous. And again, you
Yeah.
advertise that across a large asset base, and it becomes fairly meaningful.
Hey everyone, we'll be right back to the episode, but one quick note, success doesn't happen in a vacuum. So if you'd like to learn more, you want to go deeper and interact with like-minded people, I'd love to have you join the free Path to Freedom Facebook group. You can join by going to pathtofreedom.com/group and become a part of the Path to Freedom community. All right, back to the episode. And is this like pretty common stream or mainstream across storage units, or is this one of those areas where if you come in and buy, a storage facility that, maybe the same people have owned it for 25 years and they're not, operating the way you guys run your properties, is it pretty common that they may not be offering that, and that's a easy, quick win to come in and start offering the insurance?
Yeah, it of course varies by the seller type, but
Sure.
we have some sellers. We bought a deal in Illinois, for example, a couple of years ago, and the banner on their website is "We never increase rates." So we had some customers who've been in there for 5 years, paying the same amount of rent that they were 5 years ago, and they didn't sell tenant insurance. Other seller types that we have will have some insurance in place, but their team maybe is not incentivized well to sell it, so their penetration is fairly low.
Yeah.
But I would say generally, if we're buying a value add acquisition, their late fee income and insurance income and U-Haul income is probably lower than we can get it to. So that's a big value creation component for sure.
Makes a ton of sense. What about RV parking, trailer parking, boat parking? Would that fall into ancillary services, or is that
No,
part of your
we would
rent?
include that in our base rent revenue number, our
Okay.
kind of normal revenue, so to speak. And we there are operators out there who do boat and RV parking as a primary strategy. Like it might be a big fenced off lot and all this
Yeah.
boat and RVs. Some of them have climate controlled interior boat and RV parking. We've got boat and RV parking on most of our sites, but it's certainly a secondary revenue stream compared to the revenue on storage units.
Sure. Yeah.
We built a property in Longmont that we opened up in December. It's a town north of Denver. That's got about 50 boat and RV spaces. So it's a good way to generate revenue on excess land without a lot of cost, right?
Yeah.
You might spend $100,000 striping and paving, but you might eventually get to $20,000 a year, and 20% return is pretty good.
Yeah, absolutely.
It's not a lot of dollars, but it adds up for sure.
Yeah. Yeah. Well, and it's if it's just unused space otherwise, why not? And all those things together, like, I mean, you're really helping me, and I'm sure the audience really see the appeal of storage units as an asset class. I mean, I work with franchise businesses and own franchises, help people evaluate and get into franchise businesses, and like this is checking a lot of boxes that really savvy business investors are looking for. Predictable, recurring revenue, multiple revenue streams. Opportunity to come into an industry where a lot of your competition is relatively unsophisticated. Like really savvy business investors love industries like home services and home improvement because they're scalable. They tend to have less overhead than a lot of these other types of franchise businesses out there, and the competition's just because there's a lot of smaller independent companies and kind of mom and pops, and they're just not able to operate in as sophisticated of a manner, and it's not that difficult to come in and kind of exceed customer expectations very quickly. So I'm seeing a lot of similarities between some of what I do and the self-storage industry. So look, with the time we have left, I want to make sure the audience gets a good sense of what you guys are really doing there at Van West Partners. What this could look like from an investor standpoint. And, if you'd like, we can just kind of use me as a case study, right? Let's say I've got I don't know, let's use an easy number, $100,000 that I'm looking to put into a real estate investment. Walk us through kind of what my options might look like if I decided that I wanted to invest some of my capital with you.
Yeah. First of all, and this is true for kind of any sponsor you might talk to, all of our return targets are wrong, right? The deal never goes like the model says it will. Like if you go out and buy a new franchise and you've got a 5-year cash flow model, I guarantee that model's wrong, right? It's hopefully wrong in the right way,
Yeah.
but it could
Yeah.
be wrong
You hope.
right? So these return targets are just that, they're targeted, right? And they're based on reasonable and achievable assumptions. At least we believe they're reasonable and achievable, but we're also making assumptions on values and rents and cap rates in 5 or 7 years from now, right?
Right. You're making an educated guess,
Yeah.
but you can't. And look, because it's the same with, a good franchise is going to give you, a bunch of data points and, examples of existing franchisee performance. There's a lot of modeling you can do, but I always remind people, I'm like, look, you spend enough time with that spreadsheet, you can make it say whatever you want it to say, but
Yes,
you need to run a few different models, right? Like run a worst case scenario, kind of middle of the road and best case scenario, because there's certainly no guarantee that it's going to play out exactly the way you think or even hope it will.
If a deal's not working, you just increase the rent growth and you decrease the exit cap rate. Suddenly it's a deal, right?
Yeah.
It wasn't a deal 30 seconds ago.
Yeah, that was easy, right?
Yeah, we generally though, and there's a couple, I won't get too far in the weeds on this, but if you're out there considering making a passive investment in a private placement vehicle, apartments, industrial storage, whatever it might be, there's a couple of metrics out there that are kind of important to understand. And one of them is IRR, or internal rate of return. And a lot of us listening have probably heard that before. And IRR is simply, it's a return metric based on a time-weighted series of cash flows. So it accounts for time. And the second metric that's important to understand is multiple, or equity multiple, or MOIC. And that purely means how much profit are you targeted to realize as a percentage of your original invested capital. So if you're putting 100 grand and targeting getting 200 grand back, that's a 2x multiple. If you put 100K in, get 150 back, that's a 1.5. And where it gets kind of weird is if you get a 1 multiple, you broke even, right? If you get less than a 1 multiple, you lost money. So you try to avoid that. You don't want those deals. But as you look at different deals out there, you want to kind of blend those two metrics together. And multiple does not account for time. So let's say I say, hey Wes, I could double your money, dude. You're probably, okay, all right. And let's say I tell you, I can double your money over 20 years. No, that's not a great return, right? I don't want to do that deal. And that's where IRR comes in. IRR accounts for time. So we generally underwrite our deals to a targeted mid-teens, sometimes high teens IRR. So call it, the lower end 15%. And we target our multiples around 2 to 2.25, kind of depending on the deal.
Okay.
So in round numbers, if somebody invests 100K with us, we're endeavoring to return 200K plus back to them in distributions over a 5 to 7 year period.
Got it.
And the risks are you lose all your money. Right, you're an equity investor. You have membership interest in the LLC. So there's downsides, like buying. People ask, well, what's my return going to be? It's like, well, you're going to call up Jeff Bezos and ask him what Amazon stock's going to be trading at in 5 years, right? He doesn't know what you do, so that there's risk to it. But you're relying on him. I mean, he's kind of stepped back, obviously, but you're relying on him and his management team to go out and run the business and execute and create value. And it's the same thing in private real estate investing. So there are benefits to it, but there's certainly risk. And the benefits are you're getting most of the upside. You're not putting a lot of work into it other than signing documents and reviewing reports and whatnot. You're enjoying the depreciation along the way. You can use depreciation to offset other passive gains in your portfolio.
Okay.
And you're getting exposure to an asset class, whatever the asset class might be, without having to go out and build a business around buying those types of assets and operating them.
We'll get right back to the episode in just a minute, but if you've been considering business ownership, If you're already a business owner looking to expand and you're curious about franchising, I'd love to connect with you, answer any initial questions that you have, talk about a specific franchise, and detail the exact process that I use and have taken hundreds of people through to help them understand franchise ownership, find the right franchise for them, and conduct the necessary due diligence. Click the link in the show notes if you'd like to schedule a free, no obligation strategy call. I look forward to talking with you. And now back to the episode. Yeah, I mean, to me, that's what's so attractive about, this or multifamily. I'm also really, intrigued by like industrial warehousing type real estate. Like I said, we've owned an insulation business. I work with a lot of these home service, home improvement franchises, most of which, if not from the very beginning, once they get a year, 2 years into business, they need, warehouse, they need flex space, and there's just not enough of it out there. But it's the passiveness of it, right? And it's been kind of interesting how, like when I first started this podcast, it was really business ownership was the focus, right? And that was the key to, financial and time freedom in my mind, right? Because that's kind of the phase that we were at personally, was getting businesses going and, getting away from working underneath someone else. And that's been great. And I think for most people, business ownership in some form or fashion is a key component of really, getting yourself to a point of true freedom, time and financial freedom. But, most people, unless you're Elon Musk, like there's going to be a limit of how much bandwidth you have to operate businesses, even if you're a great manager, even if you're a great delegator. And so like, that's what my wife and I are kind of learning, is we've kind of gotten to that point. And we have young kids and stuff. And like, we got into all of this because we wanted more control of our time. We're not afraid to work hard. We've always worked hard, but now we've got good money coming in from these businesses we've been working so hard building. We want to learn smart ways to put that money to work for us that's not going to require a huge amount of our time. Otherwise, this is part of why we sold this insulation business last year. It was just taking us further away from what our ultimate goal was. It was giving us good income, but it was taking up too much of our time. And so that's, to me, what's so attractive, and why groups like yours are important, because I don't have the knowledge that you have on self-storage units. I mean, all these different variables that you guys evaluate when you're looking at a potential deal. But if I trust you and your team, this is a really good investment vehicle for me, and a really good way for me to put my money to work. And obviously there's no guarantees, right? But based on the targets that you guys are shooting for, and I'm sure you're able to provide, some sort of data in terms of what previous investors have seen, even if you're close, you're going to do far better than if you just put your money in the stock market or a 401k, where it's kind of locked up until, you're 60 something.
If you're out there looking for, passive real estate investments, one thing that you might think you want to ask about is track record. Yeah. And track record is meaningful. Don't get me wrong, but track record, in my opinion, is less meaningful today than it's ever been. Everybody was an American hero in the last, 7 years or whatever of real estate investing. I mean, you could be a terrible operator. You could be, over your construction budget, behind schedule, and your first multifamily development deal, and you had terrible execution, but you were saved by rising rents, compressing cap rates, and a historically low cost of capital with debt. You almost couldn't screw up. So when you look at DEX and you see these crazy IRRs and multiples that everyone's generated, through 2022, yeah, they did that, and that's great. But those days are kind of over right now. Those tailwinds have shifted now to headwinds, and there's still opportunities out there. But I think as you get to know sponsors, understanding who they are as a management team is perhaps more important than their track record or the asset class that they're focused on. Yeah. And people always ask, well, what's my return going to be? and oh, look at all these great deals we did. What you should be asking is, tell me about your worst deals and what happened.
Mm.
Tell me how you weathered the last downturn. What was the outcome? How'd you come out the other side? I think understanding your partner's failures is a lot more important than understanding their successes.
Yeah, that's really interesting, and I think great advice, and similar to a lot of the coaching I do with the people that I'm kind of guiding through the franchise purchasing process, because you need to really know and trust the franchisor, right? The team that's going to be kind of there supporting you as a franchisee. And track record is important, right? And with a franchise, you get access to a lot of data, based on what the franchisor, if they own and operate their own units of the business, what existing franchisees have done. But with business ownership, no two franchisees get the exact same results. There's always a bell curve. There's always going to be top performing owners, underperforming owners, and everything in between within the same brand. So kind of like we talked about with the modeling, you can look at a franchise, and if you only look at the top performers, your takeaway is going to be like, damn, this is a great opportunity. But if you only looked at the underperformers, you'd be like, there's no way I'm investing in this. So there's nuance to it, right? You need to really dig a little bit deeper and understand what is the nuance, what separates the most successful owners from the least successful. But I love your question that you recommend of like, tell me about some of your failures, because that's something I encourage all of my clients to ask the franchisor about is, hey, tell me why some of your underperforming franchisees are underperforming, right? And if you can figure out what the difference is between the top performing and the underperforming owners, and why the top performing owners are excelling, then you got to just kind of look yourself in the mirror and say, all right, do I think I can replicate what they've done? So I don't know, I see some similarities, but I think it's really good advice that you share. One other thing I wanted to ask you, I know we're kind of coming up on time here, but it sounds like you guys maybe have a few different types of investment opportunities. I think you mentioned like a single property fund versus I forget the terminology that you use for it, but I assume it's a fund where you're kind of spread across multiple properties. Is that accurate?
Yeah, really the main difference between a fund and a single asset syndication. When you're buying into a fund, it's like you're buying a mutual fund of, say, self-storage stocks, for example. So you're inherently a little bit more diversified. Your ownership is amortized across a larger geographic footprint, different deal types. And if you're investing in a single asset syndication, you're kind of buying one storage stock, right? Versus like a mutual fund of storage. Some people like funds, some like syndications. Where deal flow has been so light lately, when I say lately, it's been like that for like a year, maybe more. We're in the process of closing out our storage fund, and we've got a number of single asset syndication opportunities coming up. We're just not seeing the volume and deal flow to justify launching a new fund.
Okay.
And frankly, the market hasn't shifted that much. So if we launch Fund 4 today, what's Fund 4 doing differently than what Fund 3 was doing? Right? Well, the answer is not much. So we're doing these deals in single asset vehicles. We do have one in Jacksonville, Florida. That's coming up here, our second round of funding pretty soon. We closed on it a few weeks ago. It's a value add existing facility, and we're going to build an expansion on it of about 30,000 square feet. And we have a couple deals that are in contract and LOI negotiations here on the Colorado Front Range. We got one in Atlanta, Georgia. We have one deal in Dallas, Texas. So we've got some stuff coming out for sure. Different kind of return profiles, different risk profiles, but we are finding deals, just not the volume that we like. It's a very wide funnel at the top and very narrow at the bottom.
So does someone need to be an accredited investor to invest with you guys?
They do, and for those of us listening who aren't clear on what that is, accreditation. There's some vehicles that have an offering designation where they can accept a certain amount of unaccredited investors. Other vehicles have to be only accredited. We're the latter.
Okay.
And accredited simply means if you're married, you make $300,000 a year, and you reasonably expect to make $300,000 a year going forward.
Yeah.
And if you're single, it's $200,000 a year. So there's an income threshold qualification, or there's a net worth threshold qualification, and it's not both income and net worth. It's either income or
One or
net
the other,
worth.
right?
And the net worth metric is purely you've got to have $1 million in net worth outside your primary residence. So
Right.
either
Yeah.
that income threshold or the net worth threshold makes you accredited, and you have to get a letter from your CPA or your financial advisor that says, "Hey, Wes is accredited, signed CPA." Unfortunately, we only allow accredited investors in to our vehicles, and we've just found that's been, not necessarily unfortunately, but we found that's kind
To
of
me, it makes sense.
cleaner
Yeah.
designation.
Yeah.
So that's what we do.
Yeah. And then can you touch a little bit on, because there's something similar, for people that are looking to invest in franchises, where there are ways they can leverage retirement funds, to fund all or just a portion of the startup cost in a franchise business. And I think with this, you can use self-directed IRA funds. Is that a valid strategy?
It is, yeah, and that's a whole other podcast on kind of the ins and outs of that. But
Yeah.
we have quite a few. I would say maybe 15% of the equity we raise is through self-directed retirement accounts and some 401ks. And it kind of depends on your age, but if you're getting into a strategy that's more of a medium-term hold, you're not retiring anytime soon, that's kind of a good place to park it. There are some benefits in that when there's hopefully a big gain down the road and you get depreciation, recapture, and capital gains, you get a lot more tax efficiency.
Yeah.
But the downside to it, again, a lot of nuances to this, but the downside to it is during the hold period, you're not enjoying the benefits of that passive loss from a depreciation perspective because it's
Yeah.
yeah.
Yeah. That's a good point. Yeah. Look, there's always pros and cons to any of these different kind of funding or even tax strategies. Same thing applies if someone's considering leveraging retirement funds for a franchise business, and it's a personal decision, right? Like in my experience, some people they can't stomach the idea of touching retirement funds, right?
Right.
Whereas other people can't, they'd much rather leverage that asset that they've been building than go take on a bunch of debt, so
Yeah, it's kind of house money to a degree, and
yeah.
depending on your philosophy and your age, you can't touch it anyway.
Right.
And if you lose it, you've probably got some runway left to rebuild.
Yeah.
And you can't use it to pay your rent or pay your mortgage or buy a
Right.
car. So you might as well
Sitting there and you're kind of hoping for the best.
Yeah.
Otherwise. So yeah, I'm sure we could do a whole podcast on that topic alone.
Yeah, we could get
So
real nerdy on that. Yeah.
yeah. I know more about what we always work with is called a ROBS. It's rollover for business startups, and it's a whole process. And thankfully I work with some partners that's all they do, so I don't have to understand it as well as they do. But it's more accounting or finance than I ever thought I would get into. But what have I not asked you that I should have that you think the listeners may benefit from hearing?
Well, nothing specific, but if I could kind of pick one high level theme, a lot of folks out there who are interested in real estate investing, they listen to podcasts, which is great, of course. They go to seminars, they go to real estate meetups, they read books, but they don't ever take action. And if you've been thinking about doing something, whether it's buying a rental property or investing in a private placement, syndication, or fund, there's never a perfect deal. Right.
Nope.
It's never, if you're just sitting there kind of waiting for that home run probably is never going to show up. And frankly, the home runs that we've hit over the years, we never expected when we bought the deal.
Yeah.
So I guess my advice.
Never a perfect time either.
No, yeah, exactly. It's like having kids, right? It's never a perfect time to have kids. And once you do, you're glad you did.
Yeah.
Most days you are, I guess. Some days maybe.
Yeah, but you're never gonna like wake up and be like, all right, I know everything I know to become a parent. It's because I have this conversation with people in business ownership all the time. I know it applies to real estate investing too. You're never going to have all the answers. You're never going to have a guarantee of what the outcome will be. And look, in the beginning, the action could be just start educating yourself, right?
Yeah.
You know, if, you probably want to do some good research and educate yourself before you do go and throw some money in with a real estate investor, or try to do it on your own. But at a certain point, the time you're spending on research and education, there's going to be a diminishing return on that, because you can only research so much. At some point, you really do just have to, because that's where you really learn, is by doing.
Yeah, and wealth creation takes, especially in real estate, it takes a long time. And
Yeah.
if you're not getting in the game and you're kind of waiting for that perfect deal, maybe you wait another 2 years and you think you can time the market. Well, maybe the market's gone way down in 2 years and it's a great buying opportunity, but maybe it's gone the opposite direction. You think to yourself, man, I should have gotten in 2 years ago. So you've got to quantify and understand the risk you might take, but you've got to take risk to create wealth.
Yeah.
In whatever form that
Well
might
said.
take. Buying a franchise, investing in a syndication or fund, buying your first rental property. And you got to take that risk, but that's going to just turbocharge your learning curve, on what to do, what not to do.
Yeah, and it'll give you confidence, even if it doesn't work out as well as you hoped. That taking action, and in doing that, you're naturally going to learn and start to understand things better, and that just gives you confidence to keep building. And it's scary, right? To invest money, to start a business. It's taking you out of your comfort zone. We're wired to not like that or want to do that, but that's the only way growth happens. And so I try to remind people all the time, I'm like, yeah, look, you need to understand your downside, right? You need to understand the risk. Hey, if I do this and it doesn't work out, what are the risks with that? But don't forget to also think about the risk or the opportunity cost of, what if I don't do it? What's 2 years from now look like? What's 3 years from now look like? Like, what's the risk of that? What's the risk of me being in the exact same spot as I am right now 2 years from now? Because, most people, if they're looking at investing in real estate or considering starting a business, like, they've got goals they're trying to reach. Maybe they've got some pain that they're trying to move away from. They're probably not going to be content staying exactly where they are. So, you got to look at both sides of the equation.
Yeah, for many of us, our fear of loss is greater than our desire for gain. And that fear trumps that desire for gain, and that fear kind of handcuffs us sometimes, right? This is low risk, it's easy, I'm going to stay where I'm at. And you might create wealth and happiness doing that. But if you're always itching for taking a risk, you're probably a person who should probably go out and take that risk.
Yeah, 100%. Well, Jacob, this has been great, man. I really appreciate it. Where should people go to connect with you, to learn more about Van West Partners? If they want to have a conversation with you or someone on your team, if they want to, kind of stay apprised of any deals that you guys have coming up, where's the best place for folks to connect with you?
Yeah, we always love talking about real estate. And if you ever hear of a storage facility for sale that's especially off market, let us know. We'll hook you up with a fee.
Yeah.
Folks can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Awesome. We'll put all that in the show notes to make it easy for people to find. Jacob, thanks so much, man. I learned a ton talking from you. Have no doubt anyone that listens to this will as well. And wish you continued success. Keep doing what you're doing, man.
Wes, good to see you. Had a blast. Thank you.